If you're building a global asset protection plan, you've probably come across two popular options: offshore trust or Dubai-based trust. On the surface, they might seem similar. Both aim to protect wealth, provide succession planning, and keep your affairs in order. But there are critical differences in regulation, reputation, and usability that can have real implications for how well your assets are protected and how easy it is to manage them. So in this video, we'll compare offshore trust with Dubai-based DIFC trust, looking at how each works, the real-world pros and cons, and which option makes more sense depending on your banking needs, privacy concerns, and long-term legacy planning. Many people are attracted to jurisdictions like Cook Islands or Nevis because of their strong asset protection reputations. They have been around for decades and they do offer certain legal advantages, especially in terms of creditor resistance. But not everyone is comfortable setting up structures in remote islands, especially when global compliance standards are becoming more strict and banking institutions are more cautious than ever. That is where Dubai comes in. More specifically, the DIFC or Dubai International Financial Center offers a trust regime that's modern, code-tested, and fully integrated into the international financial system. It's not a secrecy jurisdiction. It's a well-regulated hub that aligns with FATF, OECD, and CRS standards. That's important if you are managing cross-border wealth and don't want to deal with constant compliance headaches. Let's take a closer look at how these two structures differ in practice. Offshore trusts, like those in British Virgin Islands or Cook Islands, operate under legal systems that have been fine-tuned for asset protection. These trusts can be extremely resilient against legal claims from creditors or litigants in your home country. In many cases, the local courts won't even recognize foreign judgments. That is indeed powerful, but it comes with trade-offs. These jurisdictions are often viewed with suspicion by banks, regulators, and even tax authorities. Opening a bank account in your own trust name can be difficult. Managing the trust might require working through a layer of intermediaries. And if you're a resident of a high compliance country, you might end up on the radar of tax enforcement just for having a trust in one of those regions. Now, contrast that with the DIFC trust. It's based in Dubai, but under common law, specifically the DIFC trust law, which draws from English legal principles. You get the benefit of a stable English-speaking court system with judges who have international credentials and commercial expertise. More importantly, it's a jurisdiction that banks actually understand. You can open accounts more easily. You can link trust to other Dubai structures such as holding companies or foundations, and you can do all this within a legal environment that respects asset protection but also understands international banking and business. Here is something else worth considering. Offshore trusts often work best when they are set up far in advance of any legal threats. Courts can scrutinize the timing of a trust, especially if it looks like it was established to avoid a known liability. In contrast, a Dubai trust may be more readily accepted as a legitimate planning tool, even if it is set up later in your financial journey, especially when combined with a broader estate or succession strategy. Tax is another area where clarity is essential. Offshore trust can create complexity when it comes to reporting, especially in jurisdictions that require detailed trust disclosures. If you are a tax resident in Europe or Australia, for example, you may find yourself spending a significant amount of time and money on trust-related compliance. Dubai, on the other hand, does not impose income or inheritance tax on the trust itself. And because the DIFC trust is located in a recognized financial center, it's less likely to trigger red flags with international banks or auditors, provided that your reporting is in order. And then there is reputation. To be honest, offshore trusts are increasingly being lumped into the category of tax havens, even when they're set up for legitimate reasons. The media, tax authorities, and even your own advisors might question your motives. Dubai-based trusts don't carry that same stigma. In fact, using a DIFC trust may signal that you're serious about doing things the right way, especially if you're managing assets in multiple countries. So how do you choose? If your only priority is maximum asset protection and you're comfortable with legal isolation and perception that comes with it, then an offshore trust, for example in Cook Islands, might still have a role. But if you want something that balances protection with practicality, something that allows you to bank, invest, and plan your succession from a reputable jurisdiction, then a DIFC trust is often the better choice. Many of our clients come to us after trying the offshore route. They've struggled with banking, they have been questioned by compliance officers, they've faced delays in managing the trust or explaining it to the family members. And in many cases, they've moved their structure to Dubai because they want clarity, efficiency, and recognition. That doesn't mean that offshore trusts are obsolete. In fact, there are situations where they can complement a Dubai structure. For example, you might use a Dubai trust as your primary holding vehicle and then layer in offshore entities for specific assets or jurisdictions. That way, you get the protection benefits without sacrificing usability or reputation. Another point to note is control. DIFC Trust gives you clear mechanism to retain influence over the trust while still achieving protection. You can appoint protectors, you can define reserved powers, and you can link the trust to a foundation or a family office. Offshore trust offers some of these features too, but the flexibility and legal clarity often requires more time and legal fee to get it right. Cost is also a factor. Setting up offshore trust can involve fee in multiple jurisdictions, trustee fee, registered agent's fee, and legal opinions. And ongoing management cost can add up quickly. Dubai Trust, especially when structured through the DIFC, tend to have a more transparent cost structure. You know what you are paying for, and you're operating in a business environment that is favored towards global entrepreneurs and families. Ultimately, the best structure depends on your goals. Are you looking for discretion or respectability, maximum legal protection or maximum usability? Do you want to keep trust hidden, or do you want to link it to your banking, succession, and legacy plans in a way that actually works? You don't need to choose between black and white. In many cases, the right answer is a hybrid approach, but if you're leaning towards Dubai, you're not alone. We have helped clients from Europe, Asia, Africa, and Australia transition to a DIFC structure, not because they need a secrecy tax haven, but because they wanted something real, recognized, and robust. If you own a business or real estate, don't wait for legal or health crisis to start thinking about protecting your wealth. Many people think asset protection is only for ultra wealthy. But the reality is that some of these solutions cost as much as setting up a free zone company in Dubai. If you want to secure what you have built and ensure your legacy, you can request your free and customized asset protection plan by clicking the link in the description below. And if you're serious about building long-term financial security, you should really check out my next video right here.